Okay, well, welcome to everybody. I'm Susan Asadi. I'm the Executive Director of the Global Chamber New York City chapter, and want to welcome good day, good evening, wherever you are, to people tuning in from our large global audience. And I'd like to welcome you today here in New York. It's noon to this New York City hosted event. We're going to have a presentation today on the capital life cycle of a company. So we have two presenters. It's really going to be a conversation. I'm going to ask them a couple of questions. I want you all to think about questions you might have about capitalizing your business. So we'll have a period of time near the end to have you ask those questions. So Ling Chang is the CEO of Ledger Funding, and that is a fintech company that democratizes business access to and choice of working capital solutions on a funder agnostic platform on a distributed ledger technology. She's a lifetime learner. She embarked on her entrepreneurial journey after serving as the CEO of a company called Stromasys, a leading processor emulation software company in Geneva. So I'm going to start with a couple of questions for her, and then we're going to pivot to Toby. They're going to be discussing resources and considerations for growing companies and individuals. So first, we're going to start off talking about early stage funding. So Ling, I wanted to start off with a question for you. As many people would say, it takes money to make money. So what are the capital sources for young companies, entrepreneurs starting young companies?
Sure. Well, when a young company is pre-revenue, as you know, the only asset in the company is the equity. So either you use your own money for sweat equity, or you use other people's money, like friends, family, and the so-called fools. And hopefully as you grow, you start to attract angel investors and institutional investors like venture capitalists. Or if you are really good, you can get grants from the government or foundations. Those are the sources of capital for pre-revenue young company. Once you start to gain some revenue, gain some traction, then you're going to start to need working capital to grow your business. So in that case, you have several choices. Is if the company has enough cash reserve, which is pretty rare for a young company, that would be nice. But if you don't have enough cash reserve in the company to take on orders, because you need working capital to buy inventories, to pay your suppliers or vendors to produce the goods, or hire contractors or employees to deliver services, then again, another choice is to continue to use other people's money for equity in your company. And as you can imagine, that becomes more expensive. So then you want to consider take on debt. The problem with debt financing for a young company is that the company may not be bankable yet, because the company, again, needs to have enough company assets, whether they are secured by inventory, real estate, machinery, etc. Or if not, then the personal guarantee of the entrepreneur. Another option is a revenue-based financing. So as you generate revenue, you give a portion of that to your lender. So almost like paying royalty. So that's another option, but usually that requires some minimum. You need to make some minimum amount of revenue recurring so that the lender will be able to take you on. Now, there's another solution that not too many people are aware of, is the alternative financing. These are the non-debt solutions based on the creditworthiness of your buyer, not your own. So for example, let's say your company produces specialty sauce. You start to get traction in your online e-commerce from Amazon, from whatever. And then you start to attract the attention of big retail stores, let's say Walmart. Walmart wants to place a $2 million with you to put your specialty sauce on their shelves. Let's say in a couple stores in the Northeast United States first. That's wonderful, $2 million. But you need to have money to place that $2 million to your suppliers, pay your suppliers, right? So that they can produce the sauce for you. Well, if you show your supplier, hey, I have a $2 million order from Walmart, So when you send me the invoice, I will sell that invoice for immediate payment so that you get paid right away. That would be a good way to make that breakthrough sale to a large retailer. So how does invoice factoring work? Is that for that $2 million invoice, or well, actually, is the retail price is $2 million? It probably cost you, let's say, $1.5 million is your cost. So your supplier issues you a $1.5 million invoice. You sell that invoice to a factoring company for immediate cash. So that company will pay your supplier right away. And then you receive the cash, and then that company will collect the payment from Walmart. So as you can see, that's a good alternative financing solution because it relies on the creditworthiness of the Walmart. Now, let's say you keep on growing. Now Walmart's going to start to, I'm just using Walmart for example, is going to place a $10 million with you because the $2 million for a couple of stores in Northeast is turned out to be a hit. Now they want to roll it to nationwide, $10 million order. Now your supplier is cash constrained. They don't have enough money on their own to buy materials to make the sauce for you. So that's where purchase order financing comes in. That the financial company will pay your supplier upfront to cover the cost of production so that they can buy material, produce the goods for you, and ship them to all the stores nationwide for Walmart. Now, so these are the two options on the supplier side. There are others, such as reverse factoring or supply chain finance on the buyer side that the buyer will help to arrange. So we can talk more about that, or maybe that's a good segue to a new set of questions, and we can come back to that if people have questions about what's available on the buyer side.
But just to clarify, so ledger funding is their sweet spot is alternative financing, all these different alternatives you were just describing. Is that correct?
Exactly. We are not a lender. We save the time and the worries of the small, medium enterprises to help them get the right working capital solutions by matching them with the right funders.
Okay.
Yeah. Obviously, we also provide cash flow analysis and ongoing financial reporting to help manage the business.
Okay, great. So what is the difference between a bank loan and this type of alternative financing you're describing now?
Sure. Well, first of all, is the eligibility. As I mentioned, for a business to be bankable, the business needs to have company assets, right? If even for a company with enough assets, sometimes the bank loan may not be viable because, as you know, because of the rising interest rate and the rising inflation, banks are tightening their lending standard. So it's more difficult to get a bank loan, such as a term loan or line of credit. But if a business or an individual can get bank loan, you should always do that because bank always gives you the lowest cost of capital, right? The banks take deposits from you and me, and then they lend it out. So the cost to you is lowest. But if they are not available, that's where alternative financing comes in. Now, the other consideration for bank loan is that they are usually fixed durations, right? 1 year, 2 years, 3 year bank loans. And usually they are fixed amount, $500,000, $250,000, $3 million, et cetera. And, same thing with SBA loan, a small business administration. Right now, the prime rate is 8.5%. So if you look at the alternative financing, the financing amount is not fixed. So you hear that right, it's not fixed. It's based on the size of the transaction, because I mentioned earlier, the invoice financing or the purchase order financing. If you have a $5 million order, then the financing amount is $5 million, right? If you have a $500,000 purchase order, the financing is $500,000. So the amount is as big or as small as the size of the invoice and purchase order. And the duration is based on the trade cycle, the time to production, the invoice payment. For example, the payment term, net 30, 60, 90, 120 days. And so this is good for those seasonal business. For example, agriculture, they may have a 6-month window in the year they need to meet, or or any other manufacturers to meet holiday demand. And so this can be ramped up and down pretty quickly. And very importantly, the financing criteria is based on the creditworthiness of the buyer, not your own company. And by the way, a lot of commercial finance companies have banks behind them as their source of capital because of, again, the lending criteria, because they are regulated, so they cannot serve certain customer profile. That's why they're working with this commercial finance companies to serve those small, medium enterprises until they grow up, become commercial bankable customers.
Okay, so I know since many of our members in the Global Chamber are in some fashion of import and export, how does trade finance work, particularly for these sectors, import and export?
Right. Yeah, so it's a similar concept. It's just a little bit complicated. It's because you're dealing with foreign buyers or foreign suppliers, so the risk is inherently higher. Usually, the U.S. government has an agency, Exim Bank, Export-Import Bank. They provide guarantee to the bank to cover up to 90% of the loan. But usually, there's a minimum from the bank. The borrowing amount has to be, let's say, $3 million. For small growing customers, that may not be attainable. For example, if you are an export company that are shipping containers worth of seafood, fruits, or widgets, let's say $500,000 every month, then you're not eligible to get that kind of financing, right? Because all you need is that $500,000 worth of working capital every month, maybe for 12 months or maybe for 6 months, depends on your season. So that's where the alternative financing could be another option for you to consider. Now, the complication comes in is that because you're dealing with international buyers and suppliers, usually for the first couple of transactions, the finance company may require a letter of credit from a foreign buyer so that the payment is guaranteed by their bank. And if you have already performance history with that foreign buyer, then that letter of credit is not required because you have a history. Then you can just do open account trades. And I mentioned before on the buyer side, they are reverse factoring or supply chain finance, because that can be used for importer, for example, importer of different merchandises or distributor. And that's where you can arrange by a buyer, an importer, for the finance company to pay the overseas supplier before they release goods for shipping. Okay. The reverse factoring is allow the buyer to make the supplier sell their invoices for early payment. Again, it's based on, these are arranged by the buyer as opposed to arranged by the supplier. So as you can see, these are tools that are available. It may sound complicated. I think that's why I love this space, is that I really want to bring awareness to the growing small, medium enterprises that there are alternatives out there for you to consider as another business tool. It may make sense for you, it may not, but it's worth looking at it. And when you're ready, we can match you with the right commercial finance companies to help you grow.
Okay, great, Ling. Well, we're going to come back and have some questions, I'm sure, from the people listening. I'd like to give Toby a chance now to talk about some more traditional bank financing. A little bit background on Toby. He joined Merrill in 2002, and he has over 28 years of financial experience in the industry. As a private wealth advisor with Merrill Private Wealth Management, he's strategically minded, delivering full scope of both Merrill and Bank of America capabilities. He works with private and public companies engaged in liquidity or acquisition events in New Jersey. So, Toby, you had a couple of things you wanted to say in terms of presentation, or if you would like to respond to anything that Ling just presented, and then go into your talk, however you want to handle it. Go for it.
Okay. Yeah, thank you both. And thanks everyone for joining us today. We hope the content's valuable. I view these Globinars as a resource for all of us. So again, hopefully the content will be valuable and if nothing else, interesting. So my focus today will really be on two primary topics. First are company exit preparation considerations. The second is personal pre-liquidity planning. So let me go into some detail. I plan on keeping my comments rather generalized, really in an effort to introduce these topics. Each situation does have its own unique attributes that shape events and the planning considerations. I for sure will not be able to summarize all of these, but will do my best to provide at least some higher level insights. So let me jump in and first talk about company capital raise and sale preparation and some considerations with each of those events. As a starting point, companies need to decide whether to accomplish these goals independently or by engaging with an investment bank. There's some unique attributes to both of those decisions, whether to use an investment bank or not. I'll mention a couple. The benefit of engaging an investment bank, or I'm sorry, of not engaging an investment bank is really cost and time savings. It's difficult to go through a due diligence process interviewing investment banks, especially if you haven't done it before or been involved with that community. So it is time consuming. The benefit of engaging an investment bank is that you have an advocate incented to enhance your company valuation. You might consider having a company valuation accomplished by an accredited corporate appraiser as part of this process. This can provide a reference to be used in negotiations with the investment bank and later on when you're going through your cap raise or sale. The investment bank, if engaged, will also provide their opinions on valuation. But having a separate company valuation done at times can be helpful. So I just mentioned that. If an investment bank is engaged, they will help prepare the company for a capital raise or for a sale. The investment bank will have real-time perspective with regard to your industry and what investors or acquirers are currently seeking. This can be tremendously valuable with regard to enhancing company valuation and dramatically facilitate preparing the company for one of those or both of those events. So there's a fair amount of detail maybe in my comments. So why don't I pause there and see if there are any questions.
So Toby, I have a question. What role do you play with regard to these considerations you've just started to lay out for companies on capital raise?
Yeah, sure. So my role really is as company advocate, regardless of whether Bank of America is used or an independent third-party investment bank is used. I position myself on the company side of all of those negotiation tables. A little more specifically, I'll help identify a most appropriate investment bank and provide an advisory role with regard to evaluating how best to leverage the investment bank value add. I know that may sound a bit vague, but there are often multiple conversations that happen when in the process of engaging and negotiating with a prospective investment bank. So I often fulfill that role. And my response, Susan, kind of gets me thinking about another topic that I'll just spend a minute talking about, which is, I guess, and I don't mean for this to sound like a commercial, but these are what I feel are value add, to either one of these situations. So in addition to our internal investment banking capabilities, we have formal relationships with 30 independent boutique investment banks through our Private Sale Referral Network. This gives us a tremendous amount of scope to work with companies, even down, and this may sound large to some people, but Bank of America is a very large institution. So our investment banking thresholds are often too high for what we would call sort of middle market and smaller companies. Our Private Sale Referral Network allows us to work with companies down to 20 million in revenues and 3 million in EBITDA, which is what we sort of consider on the lower end of middle market. Middle market typically is company valuations, and these are different than the revenue and EBITDA numbers, but company valuations from sort of 50 million to 200 million in enterprise value. So our scope and capability, I would suggest, are rather broad. A little more, I guess, on our boutiques. The 30 boutique investment banks that have been hand selected from over 400 boutiques located throughout the US. We do deep due diligence, identifying who we feel are the best of the best. Primary considerations to be included in our Private Sale Referral Network is deal velocity, so how many deals a boutique is doing each year, and their level of industry expertise. Having 30 that we work with allows us to be completely industry agnostic. We know within our network whether our internal investment banking is engaged or our third-party boutique investment banking is engaged. We know that we will be bringing experts really in all industry and sub-industry. So one assurance that I think is worth mentioning is that if one of our Private Sale Referral Network investment banks is willing to engage with a company owners can be well assured of excellent representation. Our PSRN investment bank not about to risk the relationship with Bank of America Merrill Lynch for one deal. And that's something that really can't be replicated by a company going out and identifying an investment bank independently. So I just wanted to mention it. As far as timeline and process, we typically engage companies 1, 2, even 3 years prior to an intended sale. Those timeframes are a little bit shorter with a capital raise, but well in advance. The company's often introduced to 3 or 4 of our PSRN investment banks, and over about an hour-long call, sometimes an hour and a half, depends on the company and how complicated the business is. Company executives are introduced to these banks. If there's a good fit, an investment bank is selected by the company. Okay. Capital raises are typically accomplished in 6 to 9 months. Company sales tend to be a bit longer. Process can take up to 12 months. I've been involved with deals that lasted as short as 4 months. Once a formal engagement has been established. So it depends, but wanted to share those timeframes. The investment bank's job is to create a bidding environment. This often results in 1 to 3x in addition to the company's valuation. So the investment bank has to be bringing value to the table. Otherwise, there'd be no point. So I wanted to reference that. So those are most of my comments on the company side. I want to spend just a minute on the personal side. As company executives and their team prepare the company for sale, what's often neglected are personal pre-liquidity considerations. Often the focus is so much on preparing the company, road showing, so going out with your investment bank or independently, selling the company to prospective investors or acquirers, and the personal needs are, again, often neglected. Considerations that absolutely should be part of a parallel timeline in preparing and selling the company are personal tax minimization, legacy planning for the founder or executive team, and overall a comprehensive personal wealth plan. All of these should be considered well in advance of the company's sale. We focus on ensuring executive team needs are fulfilled in parallel with company preparation. So I wanted to highlight, personal considerations as well as a company. So I'll pause there again. Probably have shared a fair amount of content. So want to give Susan or others a chance to maybe ask a question.
I just have one quick question, and then I do want to see if anyone else wants to address something to you or Ling. So basically, I've been hearing from a lot of public companies that roadshows are not even being done that much anymore after this sort of COVID and Zoom life. Is that the case in the people you're working with, or is that still happening as much as before?
Yeah, I mean, roadshow I use sort of as a generalized term, whether it's a private transaction or public, as encompassing the process of going out, meeting with prospective investors or acquirers. It's a selling process. So the investment bank will take a lot of that heavy lifting off the executive team. But as you get later stage in the process, those meetings wind up being pretty important, especially in private sale situations. So.
Okay, so when Ling, have you had companies that need to transition from the alternative financing to a traditional bank situation, and how would you make that transition? Have you made those introductions to people like Toby or not?
Not yet. Usually, if alternative financing, becomes sometimes when the company is growing fast, they start to make more profit and has more cash reserve. They may not use alternative financing because it's frankly a little bit more expensive, which is fine, and that's what we want them to be because we help them bridge over that gap, right? And then, as far as company ready to be sold, we're not there yet, but we'll definitely keep our antenna up.
Okay. All right. So does anyone who is listening, I know we have Charles, you usually have some good questions. Do you have anything you would like to ask Toby or Ling?
Thanks, guys. Thanks, Susan. Nice to see everybody. Sorry that it's been a while. Yeah, as I'm listening to what the two of you are saying, it occurs to me that you're talking about companies that are have some cash flow, are demonstrating the ability to generate revenue. In my case, I started a new company a couple of years ago, and we're developing software as a service to enhance what we're doing. It's a platform. It's like a sales playbook, and it has some goal setting and some nice features that seem to be kind of sexy at the moment. And then we'll have some AI in there. So as I've been dealing with my team, and we've been doing this on a shoestring budget, I know for us to really get anywhere, we're going to need funding. So my question to you is, when you're dealing with a company that is in such an early stage, is funding possible? What are the criteria that funders are looking for? In other words, you know, sometimes you hear these hotshot kids from Silicon Valley and they get $5 million. And I'm like, how the hell did that happen? Did someone just fund them on an idea? And so I'm obviously not one of those kids. I have thought about, because of my age, having a younger management team that I could put in as the face of the company. But can you tell us a little bit about what are the possibilities for companies in these types of situations like mine?
Sure, yeah, I'll jump in first. There are a couple options. The first one is obvious, that you want to raise an equity round, either with institutional VCs or angel investors, or friends and family, and those kids that raise a big round, usually they are. Nowadays, it's difficult to raise anything with just an idea, because I think we've seen the bubble. I think all the entire venture ecosystem has learned the lesson. It's not that they haven't learned from 2000, but because of the bubble, so to speak, a lot of startups are overvalued, and so they are crashing in their valuation when they raise the next round. So that's why you see a lot of layoffs nowadays. So that put that aside, the other one is there are SaaS financing solution out there. If you're a SaaS company, if you charge a monthly subscription fee, the financing comes in is that they can get those money to you upfront. So you don't have to wait for 12 months to receive all your revenue. You receive 1 year worth of revenue upfront at a discount. And then the financing company will collect from your user, and that's how you can work out the arrangement. So that's one possible way. It's called SaaS financing. There are solutions out there that you get money upfront so that you can use that money to hire a team, to expand your team, to do whatever you need to do. So those are two things that come to my mind.
So I'm hearing maybe part of what you said makes sense, and then there was another part that I wasn't clear on. So I like your idea, because we've been thinking how to charge for the services, and it's very common these days to have these platforms offer annual payment, right? It's $20 a month, but if you pay up front for an entire year, it's like $200, right?
Right, yeah.
But where does the financing part come into that? Because that's down to me basically user by user offering this. At what point do I get enough critical mass that someone with financing would want to invest?
Yeah, so if you can adjust your pricing so that you give user choices, right? If they sign up for an annual plan for a small discount, that's great. You got revenue up front. But if you continue with monthly billing, if that's most of the users are today, and that's where a SaaS financing could be another consideration for you, is that the financer will come in and buy your entire user portfolio and fund you upfront at a discount.
I got it.
Right.
And what size portfolio are you talking about? Because it would take a long time to get to, if they said $1 million, that's a lot.
No, I don't think that's, I think some of these companies, by the way, a lot of these are startups too, because they are struggling with this kind of growing pains themselves. So I think the minimum is much lower. Yeah, you and I can talk offline.
Okay, thank you.
Sure.
Thank you, Charles. Thanks, Ling. Toby, do you have anything to add, or this is not your area?
A couple of thoughts. So there's a lot of cash out there. And as far as targeting startup and seed money. So, and of course, there are boom and bust cycles. AI is obviously the new hot topic. Tech will always be, a big engine. I view tech almost as I view oil, that the tech's affected, it affects every industry, just like oil does. So, you know, SaaS-based companies certainly are not a new topic, but I think still a hot topic. As far as raising seed capital, a couple of things that came to mind. It's really about the management team and their experience. Sure, you hear about these kids, you know, whatever. Those stories are glamorized, and they do happen, of course, but typically people are looking for the experience of the management team. And then how seasoned the management team is will facilitate financing. So there's no real mystery there. Some other things that came to mind are VC money versus family office money or angel money. VC money often comes with lower valuation, high demands on the company. If there's a board, they often ask for a board seat. They want as much control of the company and the company's direction, because while all of those capital sources are in the business of making money, VCs are professional at it. There can be some real advantages to VC money because it tends to be more strategic. They will invest in companies that complement their existing portfolio. So even though there are some potential control drawbacks to VC money, there's some uniqueness in that if you're brought into a VC community, they may be also providing an ability to cross-pollinate with their other portfolio companies in an effort for all of those companies to grow. More typical sources for seed are family offices, angel. Susan mentioned friends and family. You know, raising $1 million, raising 3, 4, even 5 million, those are really hard numbers. It's much easier to raise 10, 15, you know, even 20. At those levels, companies are typically more established. So maybe there's an inverse expectation there. Small sums can be challenging, but I just thought I'd mention some of the attributes that I've been a part of.
Thank you. Just for everybody else, because I think, Susan, this might be a general question, is in terms of both of you and your services, I imagine, but I'd love you guys to confirm that you get business owners like me and anyone else on this call who's thinking about getting some form of funding. And I don't know if the rest of the team is like me, but I'm in a position where I have no idea, like how much do I give for my company and how competitive funders are. You know, let's say they love the idea. There's a chance I might get more than one VC interested. Do you usually see a big discrepancy, or are there kind of boundaries that everyone seems to follow?
I'll jump in quickly, Ling. That's okay.
Yeah, of course.
So when negotiating with investors, they're not what I would call friendly calls. They're looking to get the most for their investment, which either means a lower valuation, more equity, something. They're absolutely on the other side of the table. So, you know, the process of going about raising capital is a business unto itself. It's extremely distracting and time dilutive, but you have to do it unless you can bootstrap or self-fund. So, again, VC community is going to be hitting those things, I would suggest, at least as aggressively as any other capital source. Angel investors tend to be less sophisticated. Family offices may be somewhere in the middle. Of course, this is utterly subjective to whoever you're talking to. friends and family will be the most friendly of those conversations for the obvious reasons. So those sources are often tapped first until you can build up credibility and begin responding to those often very aggressive, not arguments, but positioning.
Right.
Clear.
Yeah, this is great. So I just want to jump in and also mention that if this is your first outside fundraising or capital raising, usually you can start with a thing called SAFE. It stands for Simple Agreement for Future Equity, because that's where it's created by Y Combinator, a long time Silicon Valley incubator. The whole idea is for startup that's not sure about their valuation, right? You can value a company as 5 million, 7 million, 20 million, 50 million. We don't really know, but usually investors, after listening, to your pitch, understand your business plan, they probably have a general idea. But to protect the founder's interest, usually they use the SAFE. It just precisely is we don't know the valuation of the company, so that it's a simple agreement for future equity. You put money in, you can assume there's a cap to protect the investors, so that when the company is ready and raise a price round later, then the initial investors' investment will be converted to equity at that point. So it's just a way, for you to kind of table the valuation discussion when you first time go out to raise outside capital. This can be used for friends and family, for angel investors, even for VCs at the early stage that invest in early stage companies.
Great, thank you.
Sure.
Okay, so does anyone else have questions for Toby or Ling? If not, I'm going to open the floor for anyone. I know we have mostly people are on just audio, but if there's anyone on the call that would like to mention something briefly about their company, it's the time you can do it. So I'm going to give you a minute or two. If there's anyone that wants to speak, you can unmute your mic at this point. I see Rhodes, Serrer was on earlier, William, Evan, Pedro. I think I saw Melanie on here before. If anyone wants to give us some kind of update on what's going on with you, you have a minute or two to speak. And if not, I think, do we have anything else to say, Toby or Ling? I think I'm going to move to give an update on what our next event is, and we can move on with our day. Thank you so much, Charles, for being active and having. This is a good conversation for the three of you, for sure. Okay, so I wanted to first of all thank everybody for being on the call, particularly Toby and Ling and Charles. And just let you know that our next scheduled event so far will be September 18th. It's around the time of the UNGA, the UN General Assembly. We're going to be doing a co-hosting event with the Baltic American Chamber of Commerce, and it will be looking at several aspects of expanding growth of U.S. and 3 Baltic states of Estonia, Latvia, and Lithuania. So that would be companies that have business in those 3 companies, or those 3 companies doing business in the U.S. And for that event so far, the mayor of New York, Eric Adams, is speaking. We have the presidents of these 3 countries, Estonia, Latvia, and Lithuania, are speaking. So I am looking for panelists who are doing business either in those 3 countries or know companies from those 3 countries trying to expand business in the US, and also anyone involved in the rebuild of Ukraine. So we're looking for a few more panelists. And if you know anyone, please email me privately. And that will be at the Yale Club in New York on September 18th in the morning, 8 to 12. So at this point, that's our next meeting. We may have another meetup, but so far that's what we have scheduled. And with nothing more to be said, Toby, do you or Ling want to say anything else?
I think I'm good as far as content, but thank you everyone for joining us today. And I hope the information was at least interesting, hopefully helpful.
Thank you, Toby. Ling?
Yes, thanks for the opportunity to bring awareness to those working capital solutions to the audience. If anyone has any question or if any of their friends and associates have questions, feel free to reach out to me. I put down my contact in the chat. I'll be happy to have a discovery conversation to figure if there's something that you could leverage now or in the future. Back to you, Susan.
Okay, excellent. Well, thank you, everybody, and we'll talk soon. Have a good rest of your day. Take care. Bye.
Thank you.